answering your questions about retirement. It's Money Talk with Michael Eastham.
I have a 401k at work and an IRA that I rolled over from my old job several years ago. Combined retirement investments are about $400,000. They are all invested in various mutual funds. I'm 64 and plan to retire when I reach 66 and a half to collect full Social Security. I have always used mutual funds for my investments because I don't know anything else. I have heard and read about ETFs and individual stocks, but don't know if they may be a better option at this stage. I'm not a financial person. Can you explain the difference so that I can understand them?
All right, let's talk about mutual funds versus ETFs versus individual stocks. First off, mutual funds and ETFs, or exchange-traded funds, are similar in one primary way, in that they both invest in stocks or bonds or some combination. One of the biggest differences is that a mutual fund can only be traded at the end of the market day, after the net asset value has been determined. Whereas an exchange-traded fund can be traded, bought and sold during the market day. So it's a little bit more liquid and more flexible when it comes to buying and selling. And then individual common stocks just means that you've done the research, or you have an advisor that manages an allocation of individual companies. You're buying the stocks, or your advisor's buying those stocks and giving you some diversification, and you can avoid some additional fees by using an individual advisor and an actively managed fund, because what happens is with mutual funds and exchange-traded funds, both of those have internal fees. So if you're paying a fee inside of the mutual fund and you're paying a financial advisor, well, in essence, you're paying two sets of fees. That can be true with ETFs as well. It's just, generally speaking, an ETF, the fees inside of ETFs are generally less than they are inside of mutual funds. However, with a diversified portfolio of individual stocks or individual bonds, in many cases, if it's actively managed by your financial advisor or by his or her company, then you're not duplicating those fees. So that can be very helpful. An important question in your particular case is that if you're going to retire in a couple of years, then you need to make sure that the allocation you have is providing you enough supplemental income in the form of interest and dividends and predictable income to ensure that your needs are going to be met. Because with mutual funds and ETFs, and even most common stocks for that matter, in order for you to get income, you have to sell shares. However, if you're invested in things like individual bonds or preferred stocks or bond-like instruments, well then you don't have to sell shares in order to generate spendable, renewable income in the form of interest and dividends. Those vehicles pay regular interest and dividends. You can spend that money if you need it for expenses, and if you don't, then we can reinvest that money to create a natural income inflation hedge for down the road when you need more income because of things like inflation or unexpected costs. A lot of information. Hope that helps. Of course, always give us a call if you have more questions or you'd like to understand further how the right allocation can help you prosper in your retirement. Thanks so much for that question.
If you've got a financial question you'd like to have answered, click on the link below to submit your question. You may hear your answer on an upcoming edition of Money Talk.